Good afternoon, Ben here, senior ITPM mentor and full-time trader. So I have a nice looking trade idea I'm going to share with you guys in a bit. First, let's have a look at what's been going on recently in the markets. Okay, so the overall volatility has picked up, VIX climbing out of its hole, and speculative fear just kind of crept back into the marketplace, which is great. Like, we love it. Higher market volatility is ideal for our trading approach. Okay, this is a trader's market. I mean, just look at the recent sell-off in crypto that presented some really nice trading opportunities. As a lot of these Bitcoin kind of miners and related stocks lost half the value, again, then some in the past month or so. And really for good reason. Like, a lot of these stocks just have been flying high with no fundamental value whatsoever besides just buying crypto. It's ridiculous. So, and look, there's been a lot of good short ideas in these high speculative names. However, there's a pretty good chance, I think, that the damage is done by now. Okay, so time to look elsewhere. And one area that I think is specifically vulnerable right now is the consumer discretionary space. Okay, so we have had recent macro data that has shown consumer weakness. So this is what's happening right now. We had last week, the University of Michigan Consumer Sentiment Index was out. It's now the second lowest reading actually on record, way below the COVID lows actually, as consumers continue to worry about inflation, unemployment stability with AI just taking over millions of jobs. And this is already underway. Okay, you see the recent US unemployment data showing an increase to 4.4% in September. It might not sound like a lot, okay, but look, it exceeded expectations and is the highest actually since October of 2021. So how do you think consumer uncertainty will impact discretionary spending, especially going into the holiday season? Well, I think there's a good chance we're going to see weakness in this space, and a lot of these stocks could start to roll over, okay, and it might not be pretty. Speaking of consumer discretionary stocks, let's have a look at Ulta Beauty. It's a $23 billion market cap specialty retailer in the US. They offer beauty products, cosmetics, fragrance, skincare, bath, body products, things like that. And yes, like, you always have some people that prioritize looking pretty above all other needs. I get it, okay? But I would argue that these products are just not essential for most people. And if discretionary spending gets cut, companies like these will likely suffer. It's not only the discretionary spending that's a problem, okay, but also rising input costs. It will squeeze their margins and really negatively impact their bottom line. Last year, revenue growth was flat, and for the first time ever, actually, they lost market share in the beauty space. And the CEO even warned that lackluster demand could impact some high margin items. And if you look at the fundamentals here, EPS growth for this fiscal year is actually in negative territory, and growth has been stagnant for close to 3 years now. The next earnings release is scheduled for the first week of December, and I think there's a good chance that they're going to disappoint. Okay, and even with like massive deceleration in the bottom and top line of this stock, of this company, the stock is sitting near the upper part of a 2 to 3 year range. So I'm not going to be surprised here if we see a 20% or more pullback, okay, over the next month or so. All right, then. So with that in mind, how can we set this up as a bearish trade using options? And with earnings around the corner, it makes sense to set this up as a calendar ratio put spread. Okay, like that, I have massive profit potential over the earnings release in case the stock just unravels. And we don't have to ask for that much. The stock is currently around 515. So if we buy 3 of the January 500 strike puts for $24, it's going to cost $7,200. And then also sell short 2 of the December 460 strike puts for 8, which gives us a credit of $1,600. So we are net long puts in this case, all right? And the total spend is 5,600, which is also a max loss if the stock just doesn't fall and rallies or stays where it's at and we don't do anything. But look, the stock is now, let's say the stock is above the short strike of 460 in December. We keep the $1,600 profit. And then it does kind of creep slower going into January as reality sets in. You get broker downgrades and things like that. And then you get to 420, which is still less than a 20% down move from here. So it's totally doable, right? In that scenario, we have the 500 strike minus the 420 price minus the cost of 24 times 3, okay, which is $16,800 profit. Plus, we get $1,600 credit for the short leg. So we have a total P&L in this scenario, $18,400 on a $5,600 spend. So it's a 3.3 to 1 reward risk. It's pretty sweet. Well, what if the stock just bombs of earnings and it falls 30%? So now it's at 360 going into the December expiry. Well, in that case, both legs are in the money. The short leg will be at a loss, but we'll have a much larger gain on the long leg because we're net long one put, plus there's time value left. So the profit would actually be $17,000 in that case, which is still a 3 to 1 reward risk in a scenario. Either way, we make money. It can even be a lot more if it unravels in a big way. Okay, so anyway, it is another great opportunity. It's a great setup based on what's going on. Massive upside, limited risk without asking for the world. That's it for now. Over and out.